Breaking news: the US interest rate problem has taken a nosedive. Stay glued to your screens as we unravel the financial drama. Will it be a roller coaster ride or a free fall? Buckle up because the stakes just got higher. The United States Federal Reserve has been grappling with a complex economic landscape, and its decisions regarding interest rates have significant implications. Here are the key points. Current interest rate level. The federal funds rate, a critical benchmark in the financial industry, has currently reached a peak not seen in the last 23 years, standing at 5.25% to 5.5%. This rate is of significant importance as it dictates the cost at which banks can borrow from each other on an overnight basis. In the past, there were anticipations of a reduction in this rate. However, the recent data related to inflation hasn't instilled the necessary confidence for such a move. The lack of assurance from the inflation data suggests that the economy might not be ready for a rate cut. Consequently, any potential reductions in the rate, which were expected earlier, may now be postponed until later in the year if they occur at all. This delay indicates a cautious approach by the Federal Reserve in managing the country's economic stability. Inflation concerns. The inflation rate in the United States for the month of March 2024 has been officially reported at 3.5%. This figure is notably higher than the 3.2% that was recorded in the preceding month of February. The upward trend in inflation has sparked a wave of worry among economists and market watchers. The situation presents a complex challenge for policymakers. They find themselves in a precarious balancing act, attempting to navigate between two significant economic risks. On one hand, there's a pressing need to rein in the escalating inflation. On the other hand, they must be cautious not to inadvertently precipitate an economic downturn. This delicate situation underscores the intricate and often challenging nature of economic management. Challenges and trade-offs. In theory, an increase in interest rates can serve as a deterrent to inflation by making the cost of borrowing higher. This, in turn, can decelerate the pace of the economy and alleviate the strain of price increases. However, maintaining higher rates for an extended period could potentially trigger a severe economic downturn. Despite the burden of these elevated rates, the U.S. economy has demonstrated remarkable resilience. Projections for 2024 indicate a GDP growth of 2.1%, a figure that significantly surpasses the 1.4% growth forecasted in December. The Federal Reserve is striving to reduce inflation to a target rate of 2%. However, the task of attaining its fine equilibrium presents a formidable challenge. Global implications. The actions of the United States are under the watchful eyes of other nations. The surge in U.S. rates has led to a significant deceleration in foreign investment in emerging markets, which has had a ripple effect on their economies. Central banks across the globe are grappling with comparable dilemmas, and their choices will undoubtedly mold the future of the global economy. The issue of U.S. interest rates is complex and multidimensional. Policymakers are tasked with the intricate job of managing inflation, fostering economic growth, and dealing with the international implications. Join our vibrant community by subscribing to our channel for the latest updates and amazing content. Tap that subscribe button and turn on notifications to stay in the loop.